Hello and welcome. In this presentation, we're going to explore standard costs and variance analysis. We'll learn how managers can use these powerful tools to move beyond arguments and finger pointing to get to the facts, using data to understand business performance and drive meaningful improvement. Here is the path we'll take today. We will begin with a real-world problem, a management dispute at a company called Upstate Pewter. We'll see how the solution begins by establishing a solid foundation, setting standards to create a benchmark for performance. Our first look at the data will be a flexible budget report, which will help us identify a spending variance, but that won't be enough. We will then dig deeper by introducing a model to analyze price and quantity variances. We'll apply this model to the company's direct materials costs, and finally, we'll discuss the most important part, interpreting these variances to gain insights and assign responsibility. Let's set the stage. Upstate Pewter is facing production problems, and the management team is in the middle of a dispute. The production manager, Gian, blames the purchasing manager, Imani, for buying a shipment of defective pewter. In response, Imani, the purchasing manager, defends her decision, stating that it was a great deal and questions how she was supposed to know the material was off-grade. The company president, JD, steps in to call for an end to the finger-pointing and asks the controller, Terry, to set up a system that can provide facts. This sets up our central challenge. How can managerial accounting provide clear answers to solve this type of operational dispute? The solution to this problem begins with setting standards. A standard is simply a benchmark for measuring performance. To create a standard cost system, we need to set two types of standards for each major input: a quantity standard, which answers how much input should we use, and a price standard, which answers how much should we pay for that input. This standard cost card for Upstate Pewter shows the standards for producing one statue. As you can see, the standard for direct materials is 3 pounds per statue at a standard price of $4 per pound, for a standard material cost per statue of $12. Similar standards are set for direct labor and variable overhead, resulting in a total standard cost per statue of $26. With the standards in place, the controller, Terry, can prepare his first performance report. This is a flexible budget report for the 2,000 statues that were actually produced in June. The report compares the actual results to the flexible budget, which tells us what the cost should have been for producing 2,000 statues. Right away, we see a $700 unfavorable spending variance for direct materials. This is a good start, but it doesn't solve the argument between the managers. It raises a new question. Why was the materials cost $700 higher than the standard? Did the company pay too much per pound, which would be the purchasing manager's area, or did they use too many pounds, which would be the production manager's area? To answer that why question, we need to dig deeper. We can decompose the total spending variance into two key components: a price variance and a quantity variance. This three-column model is the general framework we use for this analysis. Column 1 represents what we actually spent, the actual quantity of inputs at the actual price. Column 3 represents our flexible budget, the standard quantity of inputs allowed for our actual output at the standard price. The key is the new column in the middle, column 2. This represents the actual quantity of inputs at the standard price. By comparing these columns, we can isolate the variances. The difference between column 1 and column 2 is the price variance. The difference between column 2 and column 3 is the quantity variance. Now, Terry applies this model to Upstate Pewter's direct materials data for the month of June. In column 1, the actual cost was $24,700. In column 2, we calculate what the 6,500 pounds of material should have cost at the standard price of $4, which is $26,000. In column 3, we calculate what should have been spent for the 2,000 statues produced. The standard quantity allowed is 6,000 pounds, which at the standard price of $4 gives us a flexible budget of $24,000. Now we can calculate the variances. The materials price variance is the difference between column 1 and 2, which is $1,300 favorable. The materials quantity variance is the difference between column 2 and 3, which is $2,000 unfavorable. And as you can see, these two variances net to our original $700 unfavorable spending variance. This detailed analysis provides the facts that the President, JD, asked for, and it helps explain the initial argument between the managers. Let's look at the price variance of $1,300, favorable. This variance measures purchasing efficiency and is usually the responsibility of the purchasing manager, Imani. The interpretation is that Imani paid $3.8 per pound, which was $0.2 less than the standard of $4. This favorable variance supports her claim that she got a great deal on the materials. Now let's look at the quantity variance of $2,000 unfavorable. This measures production efficiency and is usually the responsibility of the production manager, Guyan. The interpretation here is that Gan's team used 6,500 pounds of pewter when the standard for the 2,000 statues they made was only 6,000 pounds. This resulted in an unfavorable variance of $2,000. Now we can connect the dots. Could that great deal have caused the problem? It's very possible that buying lower-priced, inferior materials led to more waste and spoilage in the production process, which would explain both variances. The issue likely isn't one person's fault, but rather a breakdown in coordination between departments. Let's summarize our key takeaways. First, standards provide a crucial benchmark for measuring and evaluating performance. A simple spending variance, which compares the actual results to the flexible budget, tells you what happened, but it doesn't tell you why. By decomposing the spending variance into a price variance and a quantity variance, managers can gain deeper, more actionable insights. The price variance measures purchasing performance. Did we pay the right price? The quantity variance measures production performance. Did we use the right amount of materials? Ultimately, variance analysis should not be used to assign blame, but rather to identify root causes, improve processes, and foster better coordination between departments.